Welcome to the deep dive.
Thanks. I am really looking forward to getting into this data.
So our mission for you in this session is to thoroughly examine the final part of a major real estate investment trust quantitative domain. We are specifically focusing on the quantitative data for UI Boustead REIT.
Right, and you will usually see that listed under the ticker UIBU.
UIBU operates strictly as an industrial REIT.
Yeah, and their properties are broken down into 4 distinct structural categories.
Right. It is not just standard warehouses. When we look at the scale and scope of the portfolio, we are talking about exactly 23 properties.
Yes, 23 properties, and they are concentrated entirely in just 2 markets, Singapore and Japan.
Right. And when you aggregate the value of these 23 assets, the agreed property value stands at exactly $1,904 million.
UIBU listed on the SGX-REIT on March 12, 2026.
Okay, March 12th.
Yeah, and the data we are dissecting today comes from their first business update, which was published on July 27, 2026.
So we are looking at roughly 4.5 months of operational history.
Exactly. It's a very new public entity.
I am going to go to the next slide.
Okay, so let us focus on the net asset value and the yield mechanics. The net asset value, the NAV per unit, currently sits at S85 cents.
And we have to read that number in the context of their listing. That says an M85 NAV already sits below the IPO issue price, which was 88 cents.
Right. And to add to that, the units listed 8.5% below the issue price on their very first day of trading.
So the market immediately priced the units lower than the book value of the assets.
Yeah, the market demanded a discount on that said an 85-cent literal accounting value.
Well, let us move to the property yield analysis, because the stated property yield for the portfolio is 4.89%.
Right, and we need to analyze how that calculation works. For this reporting period, the net property income, or NTI, is $29.167 million.
But that is only for a partial year, right? Because they listed in March.
Exactly. So to get a useful metric, you have to mathematically annualize that S $29.167 million period NPI. You project it over 12 months.
Okay, and then what?
Then you divide that annualized income by the S $1,904 million agreed property value. And that calculation implies roughly 5.1%.
Wait, so the implied rate is 5.1%, but the stated yield is 4.89%.
Yes. Depending on the exact asset base used for the calculation, you get slight variations. But either way, this yield places the portfolio precisely on the boundary between the decent band, which is 4% to 5%, and the good band, which is anything above 5%. The properties generate a 4.89% return, but the borrowed money costs significantly less. So the REIT retains a substantial surplus of income, which is then distributed across a smaller base of equity units.
Which mathematically elevates the distribution yield to that 7.90% figure.
Yes, it is a literal positive carry. The cheap debt creates the high yield.
I am going to go to the next slide.
And because that debt is so crucial, we have to analyze the debt metrics deeply. The all-in cost of debt is 2.50% per annum.
Which is very low by current S-REIT standards, right?
It is exceptionally low. And that 2.50% cost of debt creates a literal 2.39 percentage point spread when you subtract it from the 4.89% property yield.
So 4.89 minus 2.5 gives you 2.39.
Exactly. And that 2.39 percentage point spread is important because it clears the 2 percentage point comfort line that analysts look for.
It provides a necessary mathematical margin before the debt costs would consume the property income.
Right. Now let us detail the leverage metrics. The aggregate leverage sits at 36.4%.
Okay, 36.4%. Where does that fall on the regulatory scale?
It places it in the decent 35% to 40% band. But we must note that this rises to a pro forma 38.6% once both of their ongoing developments are completely debt funded.
So it will mechanically increase to 38.6%.
Yes. Next is the interest coverage ratio, the ICR. That is stated at 5.0x.
So their operating earnings are 5 times larger than their required interest payments.
Exactly. It is a very strong coverage ratio. Regarding the debt structure, 67% is fixed rate debt.
So the interest rate on 67% of the total borrowing will not fluctuate.
Right. And the weighted average debt maturity is 3.9 years. Importantly, there is no refinancing required until the financial year 2029.
Wait, really? No debt comes due at all until 2029?
Correct. The first maturity wall is $230 million of Singapore facilities in FY 2029. This keeps the near-term DPU totally insulated from refinancing risk.
Because they do not have to negotiate new loan terms at potentially higher market rates for several years.
Exactly. But we do need to mention the currency and rate risks. While 67% is fixed, that means 1/3 of the borrowings is floating.
Right, so that third is exposed to interest rate hikes.
Yes, and precisely 46% of their total debt is JPY denominated. Japanese yen.
Okay, this is a major point. Given that the Bank of Japan is currently expected to keep its monetary policy tight, how do we quantify the exact literal risk to the DPU if this cheap cost of debt is not fully locked in?
The update actually provides a sensitivity analysis for this exact literal risk. Because a third of the debt is floating and 46% is in yen, if the Bank of Japan raises rates, the monetary interest expense increases.
So the cash outflow to the banks gets larger.
Yes, which subtracts directly from the distributable income. The data shows that if interest rates increase by 100 basis points, so a full 1%, the ICR falls from 5.0x down to 3.6x.
That is a significant mathematical reduction in their coverage.
It is. And furthermore, it states that if there's a 10% EBITDA decline, a drop in operating earnings, the ICR falls to 4.5x.
I am going to go to the next slide.
Let us compare these figures to the benchmarks. We need to compare the 7.90% yield to risk-free alternatives.
Okay, starting with the Singapore 10-year SGS rate, which is the government bond rate, that currently sits at 2.43%.
Right. So if you subtract the 2.43% SGS rate from UIBU's 7.90% yield, it results in a positive spread of 5.47 percentage points for UIBU.
So you get an extra 5.47% to take on the property risk.
Exactly. Then we detail the CPF special account rate, which is fixed at 4.00%.
Okay, so subtracting 4.00% from 7.90% results in a positive spread of 3.90 percentage points.
That's 3.90 percentage points.
Yeah.
Now let us contrast the 7.90% yield against the peer comparisons.
These other REITs.
Right. The industrial S-REIT average yield is 7.01%.
So UIBU is paying almost a full percentage point higher than its direct industrial peers.
Exactly. And the all S-REIT average, which includes all property types, is 6.11%.
So it is significantly higher than both averages. Now, let us discuss the valuation assessment, specifically the PNAV.
The price to net asset value is 0.98x.
So it trades at a 2% discount to book value.
Yes. If we contrast this with the industrial S-REIT peer average, that average is approximately 1.00x.
So it is priced broadly in line with its direct industrial sector peers.
Right, but the all S-REIT average is 0.80x. So it is trading at a premium to the wider market average.
Okay. And what are the literal causes for this higher demanded return?
There are three literal causes cited. First, the missed IPO forecast. The portfolio mathematically generated less income than projected in its first few months.
Right, which creates immediate uncertainty.
Yes. Second is the JPY exposure we talked about. If the yen fluctuates, it affects the Singapore dollar returns, the market prices in that currency risk.
And the third cause?
The absolute absence of an operating record. They only listed in March 2026. They do not have years of historical data to prove their management capabilities.
So the market requires a higher yield to compensate for those three specific factors.
Exactly.
I am going to go to the next slide.
So we need to summarize the fundamental portfolio strengths and the inherent risks. We will start with the strongest selling points, particularly the occupancy.
The occupancy is remarkably high. The committed occupancy rate is 98.1%.
And that is actually an 8.7 percentage point increase from 89.4% back on 30 September 2025.
So they have significantly increased their lease space. And if we look at the geographic breakdown, specify the exact numbers there.
All right, so Japan is now 100.0% occupied. Every single square foot is leased. And Singapore is at 97.0%.
And the tenant quality is also a major selling point. Mention the blue chip roster.
Yes, 100% of their top 10 tenants are Fortune 500 companies or listed multinationals.
And they are on very long lease contracts.
Yes, the weighted average lease expiry, the WALE, for those top tenants is 7.8 years.
So the income from those specific multinational corporations is legally secured for almost 8 years on average.
That is correct. Another strong selling point is the balance sheet. Emphasize its ability to fund growth without equity raises.
Right, because there's approximately $300 million of debt headroom existing before they reach that 45% regulatory gearing limit.
Exactly. Because they have that $300 million in unused capacity, the development commitments for their ongoing projects are totally payable from internal funds and existing facilities.
They do not need to issue new shares to the unit holders to pay for the construction.
Right. But we also have to note the risks. There are distinct structural risks, starting with lease decay.
Yeah, this is important in Singapore. Detail the specific numbers on the land leases.
7 of the 23 properties have under 20 years of land lease left.
And what percentage of the portfolio value does that represent?
Those 7 properties represent exactly 16.5% of the total portfolio value.
So 16.5% of their asset value is tied to land that reverts back to the state in under 2 decades.
Yes. We also need to detail the sector concentration risk. The tenants are heavily concentrated in electronics and IT. That sector provides precisely 31.7% of the gross rent. Top 5 tenants exceed the 30% threshold. They account for 30.2% on a net property income basis.
Okay, now we need to discuss the shortfalls and market conditions. You mentioned earlier they missed their initial projections.
Right. There was a 4.3% MPI shortfall relative to the IPO forecast. Business space is the only JTC segment showing falling rents in Q2 2026.
So that specific property category in their portfolio is facing market headwinds.
Okay, I have a question regarding a mathematical contradiction here.
Okay, what is it?
How does the exact mathematical shortfall of 4.3% in NPI occur despite the rapid lease-up execution and the 98.1% occupancy rate? I mean, I am demanding that you reconcile these 2 literal data points.
Right. It seems contradictory, but it is a strict mechanical difference between a committed lease and a rent-generating lease.
Explain that difference.
The 98.1% is the committed portfolio occupancy. The tenants have legally signed the lease agreements. But signing the agreement does not immediately produce cash flow.
Because of delays in actually moving in? Exactly. There are fit-out periods where the tenant is preparing the physical space but not yet paying rent. And there are rent-free periods offered as incentives to get those multinationals to sign the 7.8-year leases.
Ah, okay. So the space is legally occupied on paper, but no monetary rent is collected during those specific months?
Right. The management secured the tenants, achieving the 98.1%, but because of the fit-out and rent-free periods, the actual physical cash collected missed the monetary projection for this quarter by 4.3%.
So it is just a timing mismatch between signing the contract and depositing the actual rent check.
Exactly. The cash flow just lags the commitment.
Okay, that makes perfect sense. So to provide a final, strictly literal summary of the quantitative data we have discussed today.
Right. We have to reiterate the exact balance here.
The REIT balance is incredibly cheap leverage, specifically a 2.50% cost of debt, which creates a 7.90% distribution yield, directly against a set of very literal execution risks.
Yes. Those risks being the 4.3% NPI shortfall, the undisclosed JPY forward hedge ratios, the 31.7% electronics and IT concentration, and the complete lack of a long-term public operating record.
Right. Thank you for joining this deep dive.
Thank you for having me.